Well, good afternoon. My name is Sean van den Berg. I'm Head of Client Education. Welcome to today's webinar. Today we're going to discuss trading equity derivatives. We had quite a few requests from people regarding this. So to get started, just remember that we are sending out the presentation to everybody, and also we'll be including the recording. If there's any questions, just type them up in the questions section in the taskbar, and I'll try and handle it at the end of the presentation. Hopefully I'll cover most of the questions that you might have within the presentation. If I don't answer any of your questions, I'll be getting back to you on your email. But as I say, I'll try to answer most of the questions by the end of the presentation. It should take us about 45 to 50 minutes. Obviously, there will be some time at the end of the presentation for questions. Okay, so let's get started. This is the agenda. I'm going to give a quick introduction to call it the umbrella. What are derivatives? Discuss mainly some of the terminology. Most people have never been involved with single stock futures or CFDs or derivatives as such, and obviously it's a different kind of language we use when we talk about these things. So I'm going to go into a bit more detail when we talk about single stock futures and in index futures and in contracts for difference. A lot of people always ask me what is the difference, what's the pros and cons. So you're going to be, the objective today is to highlight the pros and cons and take it from there. And then I'm going to go through some examples of some long and short trades. So obviously you must understand that trading derivatives is for the trader, not for the investor. So obviously your time horizon is a bit shorter than being an investor. So that's a quick introduction. Let's get started. Before we get involved with trading equity derivatives, I always find that most people don't know what they want. So it all starts out with, are you an investor or trader? So the best way to answer that question is what I call the trader matrix. It's a trade-off between the reward and risk. Obviously, you're moving from cash into shares, from shares into derivatives. And obviously, as you move up at scale, the risk increases. So the higher the potential risk, the higher potential reward. So you must be rewarded for that higher risk. So if you look at this little matrix I've got here, on the one side, on the vertical axis, you've got the reward. We go from low reward to high reward. And on the horizontal axis, we've got risk. We go from low risk to high risk. So if you use a combination between risk and reward, if you look at the bottom section here, so I'll bring in my drawing spotlight. Okay, look at the bottom quadrant here. If you're a conservative trader, you want to preserve your capital, you're looking for low reward at low risk, then obviously trading derivatives is definitely not for you. Then you must maybe look at more the equity side, where you want to preserve your capital and you're pretty happy just to like trudge along, get inflation plus a few percentage and things like that. So obviously we're not talking about the conservative trader in this sense today. This is where we want to focus on, the top left quadrant today. You want to be a prudent or wise trader. I say that in the sense that you want to bend the odds in your favor. We talk about high probability trades, where the odds in your favor, the odds are you're going to make money. So we're looking for high rewards, but at low risk. So that's where you want to position yourself in that top left-hand quadrant. Going over to the top right-hand quadrant, some of you might be what they call aggressive traders. You are happy going with high reward at high risk. So it's very, very important that you manage your risk. So yes, we're going for high risk, but it's important that you manage that risk. And we'll be talking about some strategies a bit later in the presentation. In the bottom right-hand quadrant, we talk about being a speculative or a gambler. I call it being a gambler. This is where you want to go for low reward at high risk. Now that to me doesn't make sense to do that. A lot of people do that. And that's where people trade on impulse, where people don't do their homework, or they buy a share on the tip, or open up a position on a tip. These are the gamblers. These are the guys that are anticipating future events before it happens, and sometimes it pays off, but most of the time it doesn't. So what I want to highlight in this section here, you want to be in the top left-hand quadrant. You want to be a prudent trader, going for high rewards at low risk. And there's ways and means to do that. So remember, it's high probability trades that we want to highlight for you here. So I hope that answers the question for most people. But also we need some tools. So I talk about trading tools, and this is just to give you a quick, call it a overall concept, the way I approach the market. On our website, we have a tool called a watch list. We allow you to create 3 different watch lists. Now remember, when we talk about single stock futures, we only trade in the top 100 companies. PSG Online, we only trade the top 100 companies. Shares are tradable, liquid, better quality stocks and things like that. So the idea is that top 100 shares, you're looking at the top 40 large cap stocks, and then the next 60 companies what they call mid caps. So I suggest you go onto the website, go click on the little button called indices, and you go look at the CFD list. Take that list and then copy it and paste it into Excel. And from there, rank it by the percentage. We talk about the percentages just now again, the 15% and the 17.5%. But if you go click on the 15% and you rank all the 15% together, that is the top 40 stocks. And from there, you want to separate that from the 17.5%. Now you know what shares are large caps or which is the mid caps. And from there, what I suggest you do is create a watch list or create 3 different watch lists. One with mining and resources, one with financials, and one with industrials. So yes, we're putting 30 stocks into each. So obviously we've got 100 stocks, or some of them might be less. You'll find that your industrial list will be the biggest. Okay, so the idea is to filter through these shares, and then also highlight for yourself which of the shares are ran hedge stocks, which companies are obviously the mining stocks. But we know that the breweries and the Richmonds and the British American Tobacco, these are the ran hedge stocks. But get an idea which stocks are the ran hedge stocks. By looking at the watch list, you also get an idea which stocks are moving. So you can rank the different columns, especially on the price movement. You see which shares are moving up and down intraday. And also there's a little button called Views Investor. So you can change that watch list to a fundamental watch list that looks at the value. So it also highlights the shares that are overvalued from a valuation point of view, from a fundamental point of view. Those are the kind of stocks you maybe want to look at shorting sometime. You want to look at the shares that are undervalued. These are the stocks that you have more upside potential. So the point I'm trying to make is that the watch list is a great tool to help you to filter and save you time as such. That's where the starting point is. So that's on the website. Then if you want to trade derivatives, you need some charting software, some technical analysis program. Now obviously at PSG Online, we've got our own software called Web Professional Plus. It's a great entry-level program. Helps you track the markets, help you display various technical indicators and things like that. You can scan the market, looking for opportunities. I use Web and I use a program called Metastock. So I use the two together. Okay, there's pros and cons of each program. The bottom line, you want to create a methodology. So you want to display information. Remember, price charts, the way I look at price charts, that's my number one indicator. That's my primary indicator, is what's happening with price. So I like to use candlesticks, Japanese candlesticks, because obviously it gives you much more information than a line chart. Those of you not familiar with candlesticks, I suggest maybe look at bar charts first of all. Understand that the market moves in a range with intraday. Where's the opening price? Where's the closing price? How did the market trade intraday? What was the range and things like that? I like to use a 50-day and a 200-day moving average on top of those candlesticks. It's not so much the crossovers or giving you the timing. It's more direction. So if the share price is trading above this 50-day and the 200-day moving average, I know the trend is bullish, the long-term trend is up, and I should be more, if it's above the 200-day moving average, I should be more at long positions than in short positions. So obviously if the price is trading below a 200-day moving average, I should be looking at more short positions. So that's what I use it for. Obviously I can use other indicators and other shorter-term moving averages to help me make more informed decision. So price charts are my primary indicator. Then I use things like trend lines, support and resistance, and then Fibonacci retracement levels. These are used as tools to help me get in and out. We talk about entry and exit points. So that's what I use as an entry level. I use various chart patterns. We talk about head and shoulders and rising wedges and triangles, but also with candlesticks, we've got shorter term patterns to help us. Remember, these are all tools to help us make a better decision in our timing. And then I use the stochastic and the RSI on my graphs. It just helps me to determine where's the share on the cycle. Is it overbought, oversold? Just bends the odds in my favor. But there's a lot of other indicators you use. So the idea is to just have some kind of methodology to help you make a decision when to buy and when to sell. Okay. Then we look at the trading platform. So obviously we're looking at PSG Online's platform where it gives you that mobility. You can trade anywhere in the world. Obviously it's internet based. You can place your orders after hours. You can place stop losses and price alerts. and we'll talk about it a bit later. But also, we give you a direct market access. There's no supervisors going to say, look at your funds and say, well, there's a pause, you haven't got funds available and things like that. The system automatically does it for you. So you're trading directly on the JSE, okay, as if you were a trader, a dealer at PSG Online. So yes, you also need a trading platform with that, and that's what it gives you. The PSG Online platform gives you that. What's also very important, yes, we talk about the methodology. What's more important, we talk about money management. So this is the second M. I talk about risk management, which is stop loss, and we talk about money management, which is position sizing. So to me, to make money on the market, it's not so much about making money, it's avoiding capital losses. So risk management and money management to me are the most important. And then the third M we don't really talk about here is the mindset, the psychology. We talk about greed and fear as being aware of your emotions. So yes, we're managing our emotions, being aware of them. And that's why it's so important. I always write down what I call a trader's diary. Every time I do a trade, I have the Excel spreadsheet. What was I thinking at the time? So I get in touch with emotions. Was I objective in my approach? Am I sticking to my trading plan? That's all to do with the mindset, or the third M. Okay, so that's just a side trading tools. Let's get on to more the what we're talking about today. Talk about equity derivatives. What is a derivative? It derives its value on the underlying share. So obviously we're dealing with equity derivatives. So we're talking about it derives its value on the underlying share. So if you're an equity trader, you're still doing your normal fundamentals on the share, be it Sasol or be it Anglos and things like that, do the fundamentals and the technicals. More the technicals when it comes to trading. As I mentioned just now, we only trade the top 100 shares. Compared to equities, there's only two things we're looking at. We can go long and you can go short. Okay, where shares you can't really sell short. You can't sell something you don't have with shares. It's what we call bear selling. In South Africa, bear selling is illegal. So that's why they came up with derivatives. So you can take advantage of falling prices. So that's where the big advantage is over equities. Where if you're a normal equity trader, you anticipate the market to crash. You can only do two things. Either you're going to sell out and move into cash or into the money market, or you're going to hedge yourself using derivatives. And that's what a lot of people do. We talked about derivatives just now. But you understand that you can take advantage of rising prices and falling prices. So it doesn't matter which way the market's going, there's always opportunities. But also you must understand that sometimes you can only go long only. We're talking about it just now when we get to single stock futures and CFDs. Some shares you can't go short. What happens at PSG Online, we actually go into the market and we borrow the underlying shares, what we call script. We hold that as collateral. So some of these shares, there's not enough shares available in the market to do that. So that's why we have this thing long only. Now that's not from PSG Online. That's from our market maker, be it RMB or someone like that, or Macquarie. Okay, so just be aware when you look at that list that you want to go short, you won't be able to do that. That's what we mean by long only. The big other difference comes to when we talk about trading equities and compared to derivatives is that with shares you have to put on 100% to have a full exposure. With derivatives, you only need to put on an initial deposit or initial margin, which is roughly about 15%. You put on 15% to have the 100% exposure. So they're very capital efficient. And this is the attractiveness of derivatives. They're very capital efficient, gives you more opportunity to use your funds more effectively. But saying that, people understand that part. People don't understand the other part, which is what we call variation margin. That 15% gets ring-fenced. Okay, you have to keep it at 15% on a daily basis. Okay, so the market goes in your favor. Any profits will be deposited in your account tonight. Okay, what we call mark to market. Okay, so this is where the other difference comes in with compared to shares. You might have a paper profit on an equity account. You might have made 3,000 Rand, but only when you sell those shares will that profit be in your account. Okay, when it comes to derivatives, it's on a daily basis. So your profits and losses move in and out your account on a daily basis. So any profits will be more into your account tonight. You can use those additional funds to take out more positions tomorrow. But if the market goes against you, okay, and you don't have enough cash in your account, you have what we call a margin call. Okay, this is where we talk about variation margin, what we call a top-up. So this is where you need to top up to bring it back to your 15%. So people don't understand that these things are risky. So we talk about a cigarette pack as a health warning. Derivatives come with a wealth warning. These things are geared products. They are leveraged. Okay? In effect, you're putting down 15% and you're borrowing the other 85%. So we talk about being a geared product. For every 1 cent movement, it equates to 10 times movement. Okay? So you're multiplying your profits by 10 times. And also the other way around. A 1 cent movement against you is 10 times. Okay? That's potentially how I can move against you. So gearing magnifies your profits and losses. So I always joke, you know, you can lose the house, the wife, and the car, not necessarily in that order. So just be careful. Understand this product first of all. Understand that this thing is gearing. Understand how to manage the risk. And that's what I'm going to try and harp on today. It's managing the risk. If you can manage the risk, you manage the downside, the upside is sweeter. Okay. So this is a quick introduction. Let's talk more about terminology. We talk about opening a position. So we talk about opening a long position. This is where you're going to buy. You want to take advantage of rising prices. So you're going to be buying, like we do with normal shares. So we talk about opening a short position. This is where you want to take advantage of falling prices. In other words, you're selling. So with opening a long position, I'm buying at 5 Rand with the idea of selling at 10 Rand. I want to make 5 Rand in between. Going short, I'm doing the opposite. I'm selling at 10 Rand to be buying back at 5 Rand. Okay, I'm still making 5 Rand. So it doesn't matter which way the market goes, I can take advantage of the market. So there's always opportunities. Now, we also talk about closing a position. This is where you do the opposite. So if you are long, you'll be selling. And if you're short, you'll be buying back. Okay, so it's just doing the opposite. With single stock futures, we talk about rolling a position. And we'll go into more detail in the next slide about single stock futures. So we're talking about rolling a position. All it is an automatic close and reopening of the next dated expiry contract on the same underlying instrument. So if I had a contract, a single stock futures contract on SASL, and we have expiry date, it gets rolled over to the next contract, it has to go to SASL again. So understand that single stock futures get rolled over. We see if these don't. They can hold as long as you want to. So there's pros and cons with each one of them. Okay. So let's go into more the nitty-gritties of each one. Let's talk about single stock futures. So we're going to compare this to obviously to equities, and we're also going to compare it to CFDs. So the big difference between single stock futures and CFDs at this point in time, single stock futures are regulated by the JSE. Okay, where CFDs, the JSE is looking at regulating CFDs. It's a lot to do with obviously past experiences of companies like Dealstream and all those other situations where, remember, with single stock futures, something happens, PSG had to go bang, at least you got recourse. You can go back and say, okay, go to the clearinghouse. There's somewhere that you can have some recourse. With CFDs, PSG goes bang, for example, you lose your money. Put it bluntly like that. Okay. But the chances are very slim in the sense that we handle the risk, we manage the risk very tightly, and I explained that just now. The other thing about single stock futures compared to CFDs, it's a standardized contract. Okay, so when I say standardized contract, it's everything's always the same. One contract is equal to 100 shares. So it doesn't matter what you're buying. It has the minimum you can buy is one contract. You can't buy less than one contract. So remember, it's 100 shares equals one contract. As I mentioned just now, it's a derivative. So CFDs and single stock futures are derivatives, derives value on the underlying share. Remember, we only trade the top 100 companies. The other big difference compared to CFDs, a future has a life. So in other words, they expire. So we talk about the third Thursday of every quarter. We talk about the market, the futures expiring. So last week we had the futures close out for June. We just roll over now into September contracts. But you must understand that there's 4 quarters: March, June, September, and December. Those are the 4 contracts you can trade a year. So at the moment we are trading September contracts. I mentioned just now that your initial deposit, initial margin, it's roughly about 15%. They do vary in the sense that single stock futures are more based on price. So that's decided by the JSE. So it's still geared, roughly up to about 6 times. I'm putting down 15%. You have 100% exposure, which is roughly about 6 times. Again, same thing again, the variation margin applies also. That top-up margin I'm talking about. So it's not only the deposit you have to have. I suggest always have additional funds available in your account for that variation margin, that market profit and losses going in and out your account on a daily basis. Okay. Just remember the presentation will be sent to you guys. I suggest you go through this again. Any questions you have from that, you're welcome to send me any emails or questions. Okay. So it's being recorded and the presentation will be sent to you. So just hold the questions off. And if there's any questions, I'll answer at the end of the presentation. Let's compare to a equity trader. Here we get a scenario where investor A is confident the Sasol share is going to go up. She's got 35,000 Rand to invest. Sasol's showing it, for example, at 350 Rand at the moment. She goes buys 100 shares. I'm just going to keep it simple. There's no brokerage costs and things like this at this point in time. So 3 months later, the share price increased by 10%. So Sasol shares and makes a 3,500 Rand profit. That's not shabby. If you look at 10% return in 3 months, if you analyze it, you do pretty well as an investor. Okay. But let's look at the same scenario now with single stock futures. Okay. Also optimistic about Sasol share price going up. Okay. Now we do this. The difference is now we go buy one contract. Remember what I said just now? One contract is equal to 100 shares. So it's exactly the same scenario. The difference comes in now with the margin. I don't need to put on 35,000 Rand. In this situation, I need to put on initial margin or initial deposit of only 6,000 Rand to have the equivalent of 35,000 Rand in exposure. Okay. Remember, on a daily basis, money is going in and out of my account. And here, after 3 months, I decide to close out my position. So I do the opposite. I close out my position, I sell my contract. But the difference also comes in also with my profit. That 3,500 Rand is a percentage of what I put down. As a percentage of my margin of 6,000 Rand, my return on my investment is 58%. Can you also see why derivatives are so popular? Okay, remember the capital efficient. We'll talk about the cost just now, but you can also see the potential for the profit. Again, on the highlight, yes, there are higher risks. It's managing those risks. Be aware of those risks. Okay, so let's talk about those trading costs. They are cheap. Okay, with normal brokerage at PSG Online, we charge 0.9% with a minimum fee of 98 Rand per trade. When it comes to single stock futures, we talk about 0.4% of your exposure, excluding that. Okay, so 0.4% plus is a market maker's commission. Remember, we talk about we trade the underlying share, and then we convert that single stock future into convert that share into a future. Now that conversion is done by a market maker, be it one of the banks, whatever. They charge 0.1% to do that. Okay, again, excluding that. But you trade a brokerage on the one leg at 0.5%. Okay, still much cheaper than trading equities. You also understand there's a booking fee of 60 Rand charged per contract when a new position is open. So you can buy, for example, a single stock future on Sasol. You can buy 10 times within the day. As long as it's only in the same day, you only pay that 60 Rand once. Be careful of buying a contract today and buying another contract tomorrow, because you're going to pay booking fees on both. Okay, so obviously that increases your cost. And that is percentage. Obviously, your shares move up much higher to break even on cost. So just be aware that obviously there's a market maker's commission and a booking fee when it comes to single stock futures. Okay. Single stock futures are a bit different to CFDs in the sense that they're a bit more complex when it comes to pricing. Because interest, remember I'm putting down 50% and I'm borrowing the other 85%. That interest that you're paying on at 85% is priced into the price already. Okay, and that's determined on a daily basis. So the longer you have your contract open, so you buy the contract on the very first day after the previous day's futures expiry, and your view is in 90 days until the next expiry. Obviously, you've been charged interest for the full 90 days. But if I decide to close out my position within 10 minutes of me opening up, I'm taking a profit, obviously I get that interest back. Okay, so remember it's priced into the price already. You receive interest on the cash balances in your account, but also you get interest on the margin you're putting down. So those are the things that you must also be aware of. At PSG Online, we trade what we call dividend neutral contracts. So dividend neutral contracts really means any dividends that are expected in the next 90 days, in the quarter, is also priced into the single stock futures price already. So that also includes any interest that might be received on that dividend. Remember, they're holding the dividend for you. So when it comes to single stock futures, you do not actually receive the dividend. This is the big difference between single stock futures and CFDs. Okay, so we talk about an end contract, and the end contract for example, he has made up 100 Rand. Now, the end contract consists of two contracts. There's a Q contract and the F contract. The Q contract is the share price, and the F contract is the dividend. So let's say, for example, we expect a 5 Rand dividend being paid out in the next 90 days. You'll find that you receive the dividend, but the price drops by the dividend. So that's why I always say I say it's neutral. You don't actually get the dividend. When it comes to short trades, you pay out the dividend and receive interest. Remember, with single stock futures, if you're long, you pay interest and receive the dividend. In shorts, you pay out the dividend and receive interest. Okay. Just remember, with single stock futures, as a dividend neutral contract, you don't actually get the dividend. So those of you that actually want to take advantage of capital growth and receive the dividend, it's better to go with CFDs. So as I said, there's pros and cons with both of them. So when it comes to corporate actions, this is anything that can affect the share price of the company. So it's obviously agreed on by the directors or the board, okay, and authorized by the shareholders of the company. This is the underlying shares. And it's processed through the JSE SAFEX, or the Futures Exchange. The idea with corporate actions, you don't want to be prejudiced, okay, in the sense that the market move against you. So, for example, the company changes its name, okay, it's not going to really affect the share price, okay. If there's a rights issue, it's not going to really affect the share price. And unbundlings and spin-offs and things like that, you won't really be affected. The biggest thing that can affect the company would be a dividend. Okay, we anticipate a 5 Rand dividend and the company comes to a 10 Rand dividend. Obviously, the share price will be adjusted for that. But the main thing is you won't be prejudiced. You won't be at a disadvantage. That's the idea with corporate actions. Okay. Now, let's talk about the main advantage, I think, of with single stock futures. And that's when it comes to about hedging. If you have an equity portfolio, if you've got an equity portfolio and there's a sizable amount, and you anticipate the market to drop. Here's an example of NASPAS. Now, NASPAS, for example, made a high recently at 750 Rand. Now, we anticipate the market to pull back, okay? And this is all technical. We anticipate a pullback to at least the 50% retracement level. Now, from 750 to 250, so to 550, that's a 200 Rand drop. Now, if you've got a sizable portfolio, sizable holdings in NASPAS, for example, I might be holding 500 NASPAS shares. If it's going to drop 200 Rand per share, I've got a potential of losing 100,000 Rand on my long-term portfolio. Now, a lot of people will argue with me to say, just sell out, take your profits. But remember, you might trigger capital gains, and that's an additional thing. But also, your view is a long-term investor. You're going to be selling. So, obviously, you can manage risk in an equity portfolio by diversifying your portfolio, by spreading your eggs in different baskets. But also, here's a tool you can use to minimize the risk. So we talk about hedging. So yeah, I've got 500 NASPAS shares. I can go buy 5 contracts, which is equivalent, having the same exposure. So the share drops by 500 Rand, by 200 Rand. With my single stock futures, I make up my 100,000 Rand. So what I lose on the equity side, I make up on the single stock futures side. So I'm not really losing any money. So people argue with it, they say, but gee, you might have to pay capital gains, you might pay tax on that. So what? It's a small amount. It will work out much smaller than having to pay out 100,000 Rand or losing 100,000 Rand. So these are just decisions you have to make, especially as an equity investor. It's a tool you can use, and I suggest you guys do that. Okay. So on our website, once you've logged in with your username and password, I mentioned just now, if you click on indices and you click on the little tab here called futures, you'll find the 3 different tabs. When you click on the tab called single stock futures, to see the list available, what you can trade. Remember, if the share is not in that list, you can't trade it on single stock futures. So you can see this is the list now. There's the share code, ARC-Mattel, there's the name of the share, and it tells you we're trading the September contract at the moment. If I want to go to buy some single stock futures now, how much will one contract cost me? That's my margin requirement, 645 Rand to buy one contract on ARC-Mattel. Okay. Go down the list here, you can see here's Anglo's. Anglo's going to cost me 3,750 Rand. Okay. So these all expire now in September, and there's that list I was talking about. Okay. B stands for both. You can go long and short. There's L. For example, Amplats, you can only go long. You can't go short on Amplats. Same here. You can't go short on clicks. And so it goes on. So if you want to go short, new order book, you want to go short on new clicks, at the same now you can't do that. But I suggest print this list out so you can understand which shares you can trade with. to also understand what the share codes are and things like that. So that's a starting point. Let's talk about the trading platform. Once I've opened up the account, now obviously you need to open up a single stock futures account. You need to go click on log on, click on register, enter your ID number, username and password if you have one, but then obviously open up a single stock futures account. If you've got an equity account, you still have to open up a separate single stock futures account or separate CFD account. Remember, separate risks, separate mandates and things like that. Obviously, if you've got your FICA, you don't have to redo it again. So, but remember, you have to open up a single stock futures account. We allow up to R1 million exposure on the market without asking for a balance sheet. So that's something you can consider. Now, I suggest open up a single stock futures account and a CFD account. It doesn't cost you anything. There's no admin fee. So you can always move funds around, especially those of you that want to go short, rather than moving to single stock futures. You'll find it's obviously cheaper compared to CFD because there's no script lending fees. But the platform works exactly the same like a normal equity account. So yeah, you can see an example of an account. Is long on all all positions. Now compared to equities, you can't really have 100 positions open. It's impossible to ride all those horses at the same time. But you can see here, he's holding some Aspen, there's some First Rands, and there's some Woolies. That's what I was talking about earlier on. There's a Q contract and there's the F contract. So this year, there's 135 potential dividends. So he's got 7 contracts. How many shares is that? 700 shares times that. That's the dividends he can make right now. Okay, so if you hold that dividend until expiry, you'll get 945 Rand in dividends. Okay, but it doesn't really, remember, he doesn't really get it. It just compensates. It's priced out here already. Okay, how do you place the order? Exactly the same way you do equity. You go click on new order, enter the share code. Okay, in this situation, you want to go buy some Aveng shares. There it tells you the margin requirement, 375 Rand. Okay, so I click on a go. It tells me margin requirement. The first thing I need to do is I click on the circle for order. I want to go long or open. In this situation, you select the side. So I click on long or open. How many contracts? In this situation, I want to go buy 5 contracts. Don't go put in these shares, 500 shares. It's going to say, whoa, you haven't got enough cash available. Enter the price. It tells you the bids and offers anyway. But hopefully you've done your homework by now. Technicals, fundamentals, you put in your own little price. We're going to buy at 37 Rand. Remember, it's always in cents. And you click on submit button. Now, I suggest you do this route first. Always get the contract first, and then come back and then put your stop loss in. Okay, how does the stop loss work? Again, I go click on new order. I go click on this little button here called price watch. And you must understand the price watch and the stop loss work together. So again, I say if it drops in this situation below, sorry, I got the wrong side here. That should be below the price. Okay, I want to close out my position. How many contracts? And that's my price there. This price you put in here by the stop order. Remember, working the price watch and the stop order work together. That's a worst case scenario. Where will the market go? What price will we trade at? We'll be trading at the price alert. So it triggers at 38 Rand. Sorry, in this situation we're short. Okay. If it goes up, we're short. You want to get out at 38 Rand. Okay. Click on submit. Go to your order book and wait there. Okay. You must understand. The most important thing, the price watch and stop order have to be used together to execute the trade. If you only use a price alert, you're going to get an email or an SMS. It's going to tell you, hey, your order's been triggered. Okay. Or you've been alerted, rather. Nothing's going into the market. Okay. Only when the order is triggered will it reflect on your order book. Okay. Those are the most important things to understand about the price watch and stop order. Use that facility. They have to be used together. Okay. So pros and cons quickly. We just before going to CFDs. They're capital efficient, low trading cost. You can use it to hedge your portfolio. Remember the trading platform. You have direct market access. You can place your orders after hours, and also a facility where you can place your stops and things like that. The disadvantage. Remember the price includes interest. So as I say, it gets a bit more complicated. The quarterly rolling fee, that's 0.25%. Understand that's also could be a disadvantage. Remember, it's increased cost. Remember, we're trading dividend neutral contracts. You can have 1 million contracts on Anglos. You have no voting rights. Okay, and then lastly, obviously, gearing and risk can be a disadvantage if you don't know how to manage it. Okay, the way I look at it, there are four more advantages than disadvantages. Okay. So hopefully that gave you a quick introduction to single stock futures. Let's go into ALSI futures quickly. Aussie futures, very, very popular. You can go long and short, but this is on the index, the top 40 stocks. So they're very, very liquid. This is where the institution trade. They're very cheap. It costs you 25 Rand for contract. There's no booking fee. They're very tight spreads between the buyers and sellers, from 2 pips to 5 pips. So we're talking about a pip being each point being worth 10 Rand. So between 20 Rand and 50 Rand, that's the difference sometimes. Okay. What the guys do, this is ideal for the day trader. This is someone who wants to make 100 points per move or per trade. So the guys will try and make 1,000 Rand per trade. And the last week alone, we saw on average 1,000-point move for the day. That's just in one direction. It can be 1,000 points up and 1,000 points down. That's the volatility of the market. But the guys, as day traders, will try and grab 1,000 points. I like to grab 105 points. That's to cover my costs. 25 Rand in and 25 Rand out. The big thing about Aussie trading is it's not for everybody in the sense that it's big margin requirements. You're talking about putting down 29,250 Rand. That's the minimum margin requirement we have now. But then you're having 10 times exposure to the market. So if the market's trading at 42,000 points, this is the ALSI, okay, the top 40 index, that's putting down 29,000 to have exposure of 420,000 Rand. Okay, so that's where the gearing comes in. So profit and losses on a daily basis, obviously in your account. So this is great for day traders. These are the guys that want to trade each day. They're too scared to hold a position overnight. Okay. So big difference now compared to normal equity single stock futures. There's no expiry date. These things automatically close out. You have to open up a new position for the next contract. Okay. This is an example of a software called Swordfish. So those of you who have single stock futures account with us, you're welcome to download the software. It's for free. It's great for Aussie trading, and that's what I recommend it for. It's intraday, gives you tick by tick, 5-minute delay, 10-minute delay, and this is what the guys use for trading. Okay. So example, here's 200-point drop. That's just from 9 o'clock to 12 o'clock. You could have made 2,000 Rand on that alone. Okay. So the guys trade that. So say this is great for day trading. Talk about the ALMI. This is 10% or the mini version of the ALSI. So it's 10% of that exposure of the ALSI. Okay. Liquidity is not as good as the ALSI, but it is improving as more and more people become aware of the tool. It's a great little stepping stone to go from equities to index futures and to trade the ALMI. So the spread also is improving. However, they are a bit wider, sometimes between 5 and 20 pips, 20 point spread. So remember there that this is made up by the market maker. So the market maker tries and keeps those to track the index, the ALSI, as close as possible. In this situation, each point is 1 Rand. So the margin requirement is slightly less, in the sense it's still 10%, but it's 2,925 Rand. It's very cheap, only costs you 5 Rand. Remember, still no booking fee, and remember these things do expire, so they automatically are closed out. Okay. A quick summary on single stock futures before we tackle CFDs. Trading single stock futures offers new dimensions fixtures for long and short trades. Okay, it's great for the speculator and great for someone that's got an equity portfolio onto a hedge. So those are the main things I look at. Remember, it's a geared product, so it's attractive for the small trader. Those of you who might be swing traders, so you're holding a position from 2 to maybe 30 days. That's what you're going to use single stock futures for. Okay, minimum outlay, so it's very capital efficient and they're very, very cheap. Aussie is great for the serious day trader. When I say serious, remember the margin requirement is much higher. You need much more funds involved there. But obviously, someone's got more time to be sitting and watching the market all the time. So remember, what's in the price for single stock futures? They are regulated. Some people want that peace of mind. So you do have that counterparty risk side. Okay. Let's talk about CFDs before we tackle the questions and things like that. Very similar again, but the big difference is now this is straight OTC, over the counter. It's a contract between you as a client and PSG Online. Okay? Or it is, you're settling the price, settling at the close, the difference between where you bought it at and where we're selling it. You anticipate the market to go up, so I bought it at 5 Rand and I'm selling it at 10 Rand. Whatever the difference is, we settle. You anticipate the market to fall, you want to go short, you sell at 10 Rand to be buying back at 5 Rand. Okay, so it's still a derivative. You can still go long and short. But remember, some of those things can only go long only. The big difference is now when it comes to initial margin, where on single stock futures decided by the JSE, it's a rand value, which is roughly about 15%. When it comes to CFDs, PSG Online decide 50% margin on top 40, and then 17.5% on the next top 40, next 60 companies. So obviously, the greater the volatility, we might increase in the next quarter and things like that. But as I say, it's decided by PSG. That's where the differences come in. Variation margin, as I mentioned just now, same as the single stock futures is a top up. Okay, so you don't have to pay the full price of the underlying share. You put down an initial margin to cover that the full outlay. You put down 15,000 rand to have the 100,000 rand exposure. If the share moves up 15%, you make a 100% return. That's very simple on that. Okay, let's move on quickly, guys. We're running out of time. Just understand that there is a minimum exposure. So it's not, again, CFD is not for everybody. You need to have each contract, each trade must have a minimum exposure of 25,000. If it's less than that, they won't let you trade. So 25,000, 50% on that, you need to put on at least 3,750 rand. So again, you need much more capital to trade CFDs compared to single stock futures. If it's a mid-cap stock, 17.5%, you might have to put down a much higher margin requirement. Brokerage, exactly the same as single stock futures, 0.4% plus VAT. Those are only costs involved. Okay, each is discharged on a daily basis. It works on what they call prime, less 2%. Prime's about 8.5 now. So you'll be charged about 6.5% per annum to have that 100% exposure. Okay. So remember, with single stock futures, there's no cost to go short. With CFDs, there is a cost. So if you want to go short, rather use single stock futures. We talk about a scrip lending fee. So it's 1.5% per annum, or a minimum of 250 rand. Okay. So those are some of the big differences. So I'm going to go through this very quickly. You can see the benefits here of the costs, the exposure, 0.46% compared to a normal 1% on 1.3% on equity trade. Okay. Here's an example. I'm going to go buy 500 AVI shares. That's my exposure. 500 times my share price. That's my exposure. Deposit on that 17.5%. Remember, it's a mid-cap stock. So I only need to put out 4,837 rand to have the exposure of 27,000 rand. So my gearing in this situation is, say, nearly 6 times. My brokerage, 0.4%, so it's 110 rand. If it was a normal equity trade, it would cost me 225 rand. Okay, that's for the first 25,000 rand. And then for the next amount outstanding, another 22 rand. So minimum 247 rand if it was a normal equity trade. Okay, plus my VAT. So when it comes to single stock futures, obviously there's interest on the cost, and you receive interest on your margin. So it's going to cost you 5 rand a day, and you'll be receiving 36 cents a day on your deposit. Okay, so that's where the differences come in. I'm not going into too much detail here. You can go, when you get this presentation, go through this slide. Again, click on indices. There's a CFD list available. As I suggest, select this list, copy it, put it into Excel spreadsheet, and then rank it. And then separate the 15% away from 17.5%. You'll see the top 40 stocks and the mid-cap stocks. Okay, so it looks exactly like your single stock futures platform. Only thing is now we're looking at a CFD account. Okay, so is long of AVIs and bulletins and Harmony and Imperial and Mr. Price and things like that. So you can see that he's got roughly about 47,000 rand, and he's got exposure of 237,000. So that's where the gearing comes in. So on a daily basis, you'll see that these things are updated, obviously, as it moves. Here's an example of BATS. This is a spotlight I put out yesterday. I was anticipating a bounce off this year. So you might have bought in at these levels, and I saw today that the BATS is up, British American Tobacco. I put it out because it's a rand edge stock, and I thought there's an opportunity. So this is what it looks like. You'll go select new order, type in the share code of BATS, BTI. That was your margin requirement, 15%. If you had gone long, 100 shares. Now remember, this is the difference now. You're putting 100 shares. As long as that exposure is more than 25,000 rand to go through. So you can bring it a bit smaller. Bring it down to 85 cents. As long as it's more than 25,000 rand. Now click on submit, you got the share, and voila, you got the order. Okay. Once I bought the shares, come back, and then you're going to select your stop losses and things like that. So in this situation, once I bought the share, I click on new order again. I click on price watch, enter above or below. So obviously I'm going to put stop loss in place now in case the share price drops. If it drops below 505, get me out. So I close out my position, I got 100 shares, and that's a worst case scenario price. Remember, it trades at your price alert price. Click on submit price watch and stop order. It goes and waits for you. It's important, by the way, to set enter your cell number and your email address. Okay, to be alerted. Okay, we've gone through this already. Remember, they work together. And only when it's ordered, when it's triggered, it will be in your order book. Okay. So when it comes to CFDs, they are capital efficient, but also there are fixed quantities. As long as it's, when I say no fixed quantity, as long as the exposure is 25,000. Okay. Low trading cost, remember 0.4% plus VAT. This is the big advantage, I believe, and this is great for the position trader. Someone who wants a whole position for longer term. You don't have to worry about any expiry, so there's no rollover costs. So it's cheap in the sense that, remember, 0.25% per rollover. Yeah, you're saving yourself 1% per annum. Okay. Nice thing about it also, you can hedge yourself. Remember, as I said, a question mark here, there are costs involved. What I like about this, you're getting the dividends. You're getting synthetic dividends. You anticipate 5 Rand dividend on NASPAS, you got 500 shares, that's 2,500 Rand that's coming into your account. Obviously, it is taxable. Okay, it's not tax-free. It is taxable, but it is income. So again, you have those advantages of a PHP online platform. So the disadvantages, as I say, it's not for everybody. There is a minimum trade values involved. The disadvantage for shorting. So remember, if you want to go short, rather use single stock futures. Hence, again, I'm saying, open up a single stock futures account and open up a CFD account. You move your funds in between the two of them. Okay, it is a disadvantage gearing if you don't know how to handle it, and also the risk. But by far, there are more advantages than disadvantages. Here's some examples of trades before we handle some questions. This is the thing we put out every day called our stockbroker. This is the one we did on bulletins a while ago. We went long on the trade. We're anticipating a breakout above that resistance trend line. So that was our entry point. Our take profit was our previous high. So that's where we're aiming for. Our stop loss would be the 200-day moving average, okay, which is 277. The idea is you want to calculate my profits relative to my losses. So you want to go for potential risk-reward ratio of 1 to 2. I'm willing to risk 1 Rand to make 2 Rand. That should be your minimum. Should be never below 1 to 2. In this situation, I'm willing to risk 1 Rand to make 2 Rand 58. Okay. So my potential profit from my entry point to the target price was 23 Rand 80. That as a percentage of my entry level is 8%. Now remember, this is a top 40 stock, so that 8% divided by my 15%, I've got a potential profit of 55% on my margin. Okay, so that's why we talk about risk management. Other side of the coin is money management. If you had 100,000 Rand, you should never risk more than 2% per trade. Now, 2% on 100,000 is 2,000 Rand. Calculate what was my stop loss between where I enter and where I get out. My stop loss in this situation was 9.20. Okay, divide 9.20 to my 2,000 Rand, gives me my position size. I can go buy 217 CFD shares, okay, or remember in contracts, in single stock futures, I go buy 2 contracts. Okay, so if the share drops to my stop loss, how much have I potentially lost? Directly just 2,000 Rand. So I'm managing that risk both ways, money management and my stop loss. So that's an example of how you do a long trade. Here's another long trade. This was on Sassel. Again, there's my potential profits, my potential risk, 5 Rand. I'm willing to risk 5 Rand to make 16 Rand. So again, 1 to 3. Okay, remember the top 40 stock. So here was potential to make 4%. It wasn't too much, but it's still, it meets my criteria, 28% on my margin. In this situation, I go buy 4 contracts if I had 100,000 Rand starting capital, working on a 2% risk capital. Shouldn't go more than that. Okay, as an example of a short trade, this is where you take advantage of falling prices. This was Aspen a few weeks ago. I thought to pay out, but didn't go as much as I anticipated. I was anticipating at least a 7% drop. Didn't go as much as I anticipated. I learned my lessons with these things. You know, it's a very strong stock, way above its moving averages. So I thought, yeah, it's overbought on the RSI and stochastic. Andrew's making what they call a bit of a inverted hammer there, or a hanging man. So the entry level was a breakout below that support trend line, which it did, but didn't go as much as I anticipated. Okay. Again, what I suggest is single stock futures. Yeah, in this situation, that was my margin requirement. Okay, so My potential reward, okay, that is a percentage of my margin or as my stop loss. That's how we calculate it. Okay, here's another one we had on bats a few weeks ago. This was what I call a rising wedge, anticipated a breakout of that, and we overbought. This is where I came back to what I said earlier on, a high probability trade. The odds in your favor that the market's going to drop out, which it did. Okay, I was anticipating the market coming right back to the second trend line. Didn't go as far as that, came back to the 50% retracement level. But at that point in time, we had a potential of making 3% on our margin of 15%, which was a 42% return. That's the potential you have. So you do all the things on paper before you go into the trade. The main thing you want to work out your risk-reward ratio. Okay. So quick summary. I suggest when you get this presentation, go through it. Any questions you have, please send me questions, email, and things like that. See if there's any questions at the moment. You guys have given me no questions, so hopefully I've answered most of your questions. Remember, there's a lot of information on our PSHAN website under trade. There's different sections, trade and invest. Go click on single stock futures, go click on contracts for difference. Gives you more information about the actual product. Okay, but if I can give you a word of advice, take it slowly. Remember, you were going into geared positions, so they are capital efficient, and yes, they are cheap. They make it more efficient. But as a starting point, I suggest is do your homework. Always do your homework. Understand what the product's all about, the pros and cons. Hopefully, I have explained it in this presentation. But do some paper trading. Open up an Excel spreadsheet and say, okay, if I bought this share today, what would have happened tomorrow? We have a single stock simulator, more on the ALSI, so you can understand our margin movements and understand the costs involved there. But just trade in a normal equity simulator if you want to go long. If I bought this share, what would have happened? But start small. Go find the cheapest contract on a particular share, which one's got the lowest margin requirement. Start with that one. Obviously, still do your homework. The main point is to gain your confidence in your stock picking ability, but also understand that how the market works and things like that regarding the trends and things like that. So from my side, remember, risk and money management, number one. That's why we're talking about trading derivatives. It's all we are. We focus on making the money. More importantly, it's managing the risk and money management. So yes, that's the one M. The other M, methodology, that's the easiest part. Managing the risk and managing the money management is the hardest part. So the only way you can do that is being disciplined in your approach and also being patient. So we talk about controlling your emotions, and that's a mindset. So guys, I hope you found this beneficial. I'll see there's one little question coming through here quickly. Let me just grab this. Where's this question from? This is a question from Greg. Greg, thanks for your question. What time frames do you use for all your trades? That is great to answer your question. Depends what kind of trader you are. Remember, you get three kinds of traders. You get a day trader. That's the time frames you're using there. The guys use a 10-minute chart to do the analysis on, and then they act on the 1-minute chart. That's if you're a day trader. If you're a swing trader, someone that's doing the homework at night, you'd be using in a day charts. So you're using daily charts. What I always do is I switch over to weekly charts, look at the long-term view there, get a bit of perspective, and then I come down to my daily charts. And from there, I act on entry levels based on my daily charts. As a position trader, you might be using more of a weekly chart. That's using single CFDs. So hopefully that's what you mean by your time frame as such. I hope that answers your question, Greg. Okay. Any other questions? I don't see any other questions coming through. But as I say, remember this presentation will be sent to you guys. And please go through it, and you're welcome to phone me. Here's my, let me just go back to my normal mode. Okay, here is my contact details. There's my email, and there's my email, and there's my my direct phone number. So guys, I hope you've enjoyed this. I hope you found it beneficial. Any questions you have, please send it through to me. I'm there to help you make money. Thanks for your time. All the best.